Mortgage rates are still high, and no, the Fed is not the reason for it. They said that the average mortgage that people are having right now when they buy a house is like $3,800. If you've been waiting for rates to drop before you consider buying real estate, you might be waiting for the wrong signal. If the rates become lower, buyers are going to be able to qualify for more, and more buyers will be able to qualify then as well too.
So let's be careful about the cost of waiting.
Welcome back to Invest with Jim, where you'll find real estate insights that no one else is sharing. I'm Jim. I'm a real estate investor and real estate agent here in Las Vegas. And I'm joined today with Wes Friedman, my loan officer.
Thank you for having me, Jim.
And before we dive in, I just want to let you know that this video is not anything political. We're simply sharing knowledge, data, and what things mean when buying and selling real estate. Always consult your own tax professional or financial advisor if you have one before making these big decisions. And if you don't, and you want to talk to some people with great experience in buying and selling real estate, you can always reach out to Wes or myself too. A lot of people are wondering why. Why are mortgage rates still high in September of 2025 when all we hear in the media is the Fed's cutting rates? So why are they still high? A big misconception right now is, and clients are always expecting this, is just because the Fed cut the rates, that means mortgage interest rates will go down as well too, but that assumption is not correct. Wes, can you tell us how that all works and why things work in that way?
The Fed funds rate is what banks pay to borrow money. They, of course, lend it to you as a consumer. Currently, I believe the Fed funds rate's at 4.25. Bank or lending institution will have to provide a little different spread on that, meaning that you would pay a little higher interest rate in order for them to be profitable.
Yeah, of course. Banks are in the business of making money. If they're borrowing at 4.25, they have to add a little bit so they can make a little money on lending the money itself. Where were you going to see the most effect of rates when the Fed cuts the rate?
You will see immediate effects on car loans, credit cards, home equity line of credits. That will be immediate in each cycle that they do cut at.
Kind of more short term.
Exactly. It also will affect your yields that you would receive on a fixed investment. So if you were to purchase a certificate of deposit, the amount of yield percentage that you gain on that investment would also shrink.
Last few years, I mean, we were seeing CDs offering rates like over 5% or more, like in the 4s now, and some are even going lower probably.
Certainly, it goes both ways, but that is instantaneously.
What needs to happen to make mortgage rates go down? What do they track to determine what mortgage rates are?
If I were buying a home right now, I would pay particular attention to the 10-year bond yield because that'll have more of a correlation to the 30-year fixed mortgage rate.
Mortgages are usually like 30 years. Looking at something short-term is not a good indicator on what's going to happen with more long-term debt, right?
Exactly, because they're carrying that liability over a longer period, 30 years.
So what's going to move those yields?
That'd be inflationary readings, employment numbers, global sentiment, and economic expectations. Bond traders don't just look at current rates. They bet on what will happen 6 to 12 months out. The Fed's job is to keep inflation at 2% and also unemployment below 4%. And if the market suggests that inflation is still too high or the economy is too strong, mortgage rates can stay elevated even if the Federal Reserve pauses or cuts interest rates.
So we've seen cases like this, like earlier this year, where the Fed cut short-term rates, but mortgage rates actually went up.
And that's because the bond investors were not convinced that inflation was under control. So I tell buyers, don't just watch what the Fed does, watch how the market reacts to the overall economic picture.
So if inflation stays above 2% and unemployment continues to rise, that's when we're actually likely to see mortgage rates go down. So in a way, if you're hoping for mortgage rates to come down, you're actually hoping for high inflation and also high employment.
Because if it's just inflation that's rising and unemployment rates are not, and people keep spending and using credit cards, there'll be little incentive for the Federal Reserve to cut rates.
Let's just think about times where they did cut the mortgage interest rates. The last time I remembered was 2021 because of COVID. People weren't sure if they had jobs, the economy was slow, they cut the rates to stimulate the economy at that point. And then if we even go back even further, since we've been doing this for 20 plus years here, last time before COVID was during the Great Recession. I think in 2012, we were still coming out of the recession. The economy wasn't strong. The median mortgage interest rate back then was like 3.8% then. I guess that's another reminder of like, you know, when the economy's down, that's when they cut the rates a lot.
Yes, and if you go back to 1960, there's only been one time in history where during a recessionary period that home prices went down, and that was, like Jim said, 2008.
Caused by the real estate bubble bursting, the subprime mortgage crisis thing, and then yeah, we use COVID as an example as well too. So we're really not likely to see a big rate cut unless something really bad happens in our economy. So until then, you should make plans based on what the rates are currently. We've been working with a lot of buyers in this market and getting great deals. That's why it's important to work with people like Wes and myself who have strategies strategies and experience to optimize your buying leverage in this current market. So what's happening right now? They're saying that inflation is still somewhat high, but the Fed wants to target 2% or lower, right? So we're above that right now. When we look at real estate prices, you might say prices are dropping, right? Yes, they have dropped this current year, but year over year, real estate prices have gone up 2% actually still too, right? So that's kind of an inflation thing. That is at 2%, but there are other costs that keep rising, such as insurance, construction costs, HOAs, furniture, appliances. All those things are part of housing in a way.
It's definitely sticky inflation and the bond market is cautious. Yields have not dropped enough to force mortgage rates down.
Buyer demand still does exist. It's just that it's very selective right now. Many buyers are waiting on incentives or deals, and we see that a lot in the new construction market right now. Many new home builders are offering rate buy downs, credits, and all types of incentives. On the resale side, motivated sellers are still very flexible. Many are paying for closing cost credits to the buyer, getting repairs done, different credits, flooring credits, window coverings, buying appliances. And the sellers that are less motivated, perhaps, those are the ones that have been taking their homes off the market. They don't want to keep dropping the price, or some are actually listing them for rent as well too, like if you're an investor and you own property. So we just talked about where we are right now. Let's take a little quick look back on real estate. I always tell people this: real estate is a long-term investment. It's not like a day trading thing. It's not like cryptocurrencies. It's not going to turn around overnight. When you look at this chart here, I mean, this is a historical data about house prices throughout the years. Real estate goes in cycles, but when you look at it historically throughout the years, it always goes up eventually and to the right. You might see a little dip here, but then you'll see it rise again, right? So I always use an example of when I first started real estate during the housing bubble. So many buyers thought to themselves, like, I'm never going to be able to afford a house. Home prices are too high. I also heard that during the pandemic as well too. But everyone that actually did buy always looks back and says, man, I'm really glad I actually purchased, because I really feel bad for the people trying to buy now. That's kind of what I'm seeing historically.
You can definitely see that that chart does not lie, and property prices clearly go up when we're in recessionary periods.
Yeah, I mean, it makes sense. If the economy is doing bad, they drop the rates, right? And then it becomes more affordable. Everyone starts buying, pushes the prices up, and we go up and up again until the next time we hit a kind of a recession or something, and it's the same cycle again, right? Let's look ahead now. I think that if inflation stays above the 2% still, and we have a weak job market, meaning unemployment numbers continue to rise, I think we could probably see mortgage interest rates in like the 5s probably by Q2 of 2026.
There's no question that rates are going to come down. They've been elevated for a couple years now. I think they're going to have to look at the unemployment numbers that are coming out, and I think the Fed will quickly shift their stance on their pace of rate reductions.
Keep in mind, it's also going to cause more competition if you're a buyer, right? Because if the rates become lower, buyers are going to be able to qualify for more, and more buyers will be able to qualify then as well too. So if you have more buyers, that's an increase in demand. So if the supply doesn't change much and you have more demand, there's only one thing that's going to happen. Prices are going to go up. You're going to lose your incentives. Sellers aren't going to pay your closing costs. And yeah, you're going to compete with a bunch more buyers now. Whereas now in our current market, it's a buyer's market and you kind of hold all the cards right now.
Bank of America wrote an article recently that said over 50% of those that are approved right now are not buying a home. They're waiting on interest rates to drop.
And I mean, I totally think that's true too, because I have a lot of buyers that I'm working with right now with pre-qualification letters right now, but they're waiting because they want to see if prices will go down a little more or if rates might go down a little more.
So let's be careful about the cost of waiting.
So what signals should we be watching out for so we can know when the rates are actually going to go down more?
I would be keeping track on monthly inflation readings, such as the PCE, CPI, and PPI. If inflation's still high and we have a weak job market, then we'll likely see rates in the 5s.
So if you're thinking about buying in the future, what should you be doing right now? You don't have to wait and lose ground. There are real strategic moves that you can make right now to obtain a lower payment while we wait for rates to go down.
Exactly, like using temporary buy downs that could potentially drop your rate up to 3% from where they are today, or either 1 year, 2 year, or 3 years, depending on the program. And then when rates go down, you could refinance.
These buy down programs, how much do these cost in general? Like, give me a rough ballpark.
Usually about 2 to 3%, depending on the price of the home.
I asked that right now just to point out the fact that sellers are motivated right now in and I've seen a lot of sellers pay for this buy down or buyers who qualified for this mortgage to buy this house at these prices. I think that window will be closing if rates keep going down.
And another tool that people are using to keep their payments low are adjustable rate mortgages.
How does an adjustable rate mortgage work?
It is essentially fixed at a lower rate, lower than long-term 30-year fixed rate for a fixed period of time, usually 5 to 7 or 10 years.
So basically, if you're qualifying for like a 6.5% mortgage rate right now for a 30-year mortgage fix, the adjustable rate mortgage might be around what?
You might see somewhere in the way of 5.75, usually 3/4 to a half point different, depending on how long the fixed period is on the adjustable rate mortgage.
That would make sense. You're keeping your payment just a little bit lower by paying a slightly lower rate, but it's adjustable though.
Ideally, this buys you time for when rates come down.
Yeah, so if you're a believer that rates are going to go down, might be a good option for you.
A lot of families are moving in together and buying bigger homes, and multiple borrowers means more qualified power.
A construction trend these days are casitas or next-gen suites, because for this very example right here, you might have like the grandparents live in the ADU or the next-gen suite, right? The parents get the master and then the kids are there too. But we're seeing that in the construction trends too. So it might not be just a strategy, it might be something that we're going to see more going into the future. Another thing that we're seeing a lot in this market right now too are people that have great equity in the home that they own. They want to sell that property to buy another house. But we're not in a market where things sell so quickly again right now too. So what strategies would you give that home seller slash future borrower to do right now?
A bridge loan. A bridge loan is simply using some of the current equity in your home that you have right now that we will then use for the down payment of the new one while we wait to sell your former residence.
Another thing that home buyers should consider are kind of local assistance programs. We are here in Las Vegas, so we have a lot of people that work at the casinos, and a lot of the people that work at casinos are part of the union. I know that the culinary union offers a down payment assistance program to their members. All that takes is basically the union member has to attend some home buying classes, and then you can get like a $30,000 grant towards your down payment to buy a home. Depending on what market you're in, or if you're in Vegas, you should really look into some of these programs. There are some hoops to jump through, but for some free money, it might be worth it for you.
If you're in the trades, speak to your union representatives and figure out what type of home down payment assistance programs they offer internally.
Absolutely. And if you do start looking down the road on these assistance programs, do keep in mind of what happens when you sell the home, right? Because sometimes they do have like prepayment penalties, or you might have to pay back some of the down payment assistance if you don't own the home long enough, right? Correct. But we're still at a buyer's market right now because rates haven't dropped that much too. So last time we're in this type of market, I always tell buyers this is a great opportunity for you to get into a specific neighborhood that you really want to be in. Because if rates go down and then we switch into a seller's market again, it becomes very competitive. It's very hard for buyers to get exactly what they want. For example, if you really want to be in a Summerlin school district or a Henderson school district or something like that, well, in a seller's market, good luck on that, right? But here in a buyer's market, you actually have choices and you have less buyers to compete with. So if you're a believer that rates will go down, get that house in that location that you want right now and then work out a refinance later or something like that. But at least you have the choice and you have the ability to get into the neighborhood that you really want and not just have to settle because the market's too hot for you to compete with. So in conclusion, mortgage interest rates are not going to crash just overnight. You need a plan either way.
The best move for you is to reach out to us and let us run the numbers. Let's see what your situation looks like. We can help you make a customized game plan. We run a soft credit pull so it will not affect your credit, so you can get clarity without penalties.
We've worked together before with borrowers, and if a borrower has some debt that they need to pay off or they need to save a little more down payment, you want to know that now. So if you're planning to buy within the next 6 months, you're ready by then. Because if you wait for the 6 months and then you look at this and you're like, oh, I need to pay this off, I need to save more money, now you're 6 months behind.
And we can help you with credit, but it does take a little bit of time, so let's not wait till last minute.
So that's something that you can help with, Wes, is assess someone's credit profile and look at their trade lines and see what needs to be paid off, what's going to optimize their borrowing power.
Certainly, and we got to set a financial plan, purchasing a very large asset, and we do want to look long-term and develop a strategy that's right for your family.
Here's the thing I always tell people, you don't have to buy the house for your max qualification, right? If you qualify for $800,000, you don't have to buy an $800,000 house. You need to buy what's comfortable for you so you can still live the lifestyle that you like. Nobody wants to be house poor. No one should just spend all their money on a mortgage and stuff like that. You need to do what's in your best situation for sure. Did you know they said that the average mortgage that people are having right now when they buy a house is like $3,800? That's gone up a lot. Just a reminder of why it's important to work with somebody with experience and have seen different markets and things like that, and with your best interest in mind too. Like, we're not trying to sell you the most expensive home and max you out, and then you're in trouble, and then buying homes is no longer fun. We want to help you buy one and maybe build a real estate portfolio in the future, honestly. So if you're considering buying or selling, do reach out to us. We can schedule a Zoom. We can do a strategy session with you so we can look at your very specific scenario and come up with a game plan that is specific for you and not just kind of like a general one.
If you want to know what your mortgage payment could look like today, let's get together. I can show you that.
Text or call me or go to my website and register, and then we can schedule a strategy session together and see how we can help you. If this video was helpful, hit like and subscribe and share it with a friend who might also find this interesting. Thank you for watching. I'll see you on the next one.